very interesting around debt financing. What we're seeing, particularly at the conference, is that there's plenty of cash. And so lenders are flush looking for opportunities. And so from Mantella's standpoint, we're looking to match the duration of our deals with the duration of the capital that's available. And so deal metrics are very important, and they always were. Things like pro formas and the underwriting assumptions, but more than ever, the reputation of the manager or the reputation of the developer really, really matters. And there's different levers in a deal, such as leverage, recourse, and all that impacts the pricing. So depending on the deal and the duration of the deal, we can move a lever here or there to get to a pricing that works for our deal. The other thing that lenders are really looking at are pre-sale levels, especially these days where it's really uncertain how much or how quickly units can be absorbed, how quickly an exit can happen on a property. So pre-sale levels are something that lenders are really looking at. But overall, and we're hearing this in the conference, and it helps validate what we're seeing in the marketplace, is that the lenders are available and they are looking for deals to lend against. When we're looking at the ideal capital structure for our various product types, it really comes down to mitigating the risk in the deal. And so every deal type would have different levers that we would target. LTVs, for example, which is a leverage in the deal, we want it lower on an IPP deal than on new construction, which is kind of a mid-leverage, and we would add more leverage to a value-add deal that may have a higher duration and in-place tenancy. On the equity side, typically we would have external LPs that would invest 80 to 90% of the equity required, and as a GP, we would certainly put money into the deal at 10 to 20%. Mezz debt or preferred equity is something that we would look at on a deal-by-deal basis, and that's something that we would necessarily add to every deal. Other factors in the capital structure, as I said, certainly it is the duration of the deal, the carrying cost, and even things like location and exit timelines. Equity capital has certainly changed in our marketplace. I'm hearing this in the conference, and it's what we're experiencing on the street, is that raising discretionary pools of capital into a blind fund today is difficult. What we're more often seeing, and it's our approach to the marketplace, is that deals are being funded on a deal-by-deal basis. Some investors that have capital that are expecting it back from funds that have been frozen or locked up, and that's a real problem because the capital is not able to be recycled by those investors. So what we're seeing is that some groups are kind of frozen and they have no capital to deploy, and others with capital to deploy, they're very discerning, but some are finding it difficult to find the opportunities to meet their objectives. So it is a somewhat polarized marketplace where groups that have capital are actively seeking deals. What we're seeing though is equity investors are doing more diligence, so more sensitivity analysis, they're extending durations on deals, additional equity requirements, and increased cost or reduced revenue. And how does that look in the pro forma? Looking for cash flowing assets, and I think that's a theme that we've seen from most of equity investors. They like the benefit of having a cash flowing assets. I've often heard it said that a deal needs to have more than one way to get out of the box. And so, a pro forma may have an exit strategy, but you need to have more than one. And I think equity investors are really looking for that today. Finally, relationships matter. And having done deals with other people, a proven relationship, knowing that you can trust the other counterparty is so important.